and welcome to the Property Wealth Podcast. We're so glad you're tuning in today.
Absolutely. It's great to have you here.
So today we're diving into something that's really crucial for anyone who's flipped a property or is thinking about it. We're talking about the transition into property management after a flip. It can be a bit overwhelming, right?
Yeah, it really can be. You put so much effort into renovating and flipping, and then the thought of managing it afterward, it can feel like a whole new ballgame.
Exactly. And that's why we're here, to help you navigate that transition smoothly.
We'll cover some practical tips on what to look for in a property manager, how to set up your property for long-term rental success, and, of course, the importance of understanding tenant needs.
And we'll also touch on some common pitfalls to avoid, and how to ensure you're maximizing your investment.
Right, because it's not just about flipping the property. It's about creating sustainable wealth in the long run.
So whether you're a seasoned investor or just starting out, there's something here for everyone.
Let's jump right in and start with the first steps in choosing the right property management strategy. You know, Sarah, I think one of the biggest reasons this topic is so crucial right now is the shifting landscape of retirement. A lot of people over 40 are looking at their timelines and realizing it's not just about saving anymore. It's about building something that can really support them later on.
Absolutely, Mike. I mean, think about it. Many folks are starting to think about how they can ensure a steady income stream in retirement. With inflation being what it is, relying solely on savings and pensions might not cut it anymore.
Right, and that's where real estate can play a huge role. Property can act as a hedge against inflation. For instance, I spoke to an investor named Tom who bought a rental property a few years back. He was worried about his retirement savings dwindling due to inflation. But now, his rental income has not only kept up with inflation, but has actually increased over the years.
That's a great example, and it highlights how real estate isn't just an investment. It's a way to create financial stability. Plus, it can provide that peace of mind, you know? Like, if you have a reliable rental income, it can really help alleviate some of the stress around retirement planning.
Exactly. And there's also the emotional side of it. A lot of people in their 40s and beyond want to ensure that they're not just financially secure for themselves, but also for their families. I know another investor, Lisa, who bought a duplex. She wants to leave something tangible for her kids, rather than just a bank statement.
That's such a powerful motivation. Leaving a legacy can be really important for many people. It's not just about the money. It's about creating opportunities for the next generation.
And let's not forget about market shifts. We've seen some significant changes in the real estate market lately. Prices are fluctuating, and some areas are seeing rapid growth while others are lagging. For investors over 40, understanding these trends is essential to making informed decisions.
Yeah, and it's about being proactive, right? You don't want to wait until you're at retirement age to realize your property isn't performing the way you hoped. Being ahead of the curve can make a huge difference.
Definitely. I remember speaking with another investor, Greg, who started investing in properties in up-and-coming neighborhoods. He saw potential where others didn't, and now those properties are worth significantly more than what he paid. It's about having that vision and being willing to adapt.
That's so true. It's like a puzzle, putting together all the pieces of your financial future. And for those who are thinking about transitioning from a flip to a rental, it's vital to have a solid management strategy in place.
Absolutely. The transition period can be tricky if it's not managed well. That's where a good property management system comes into play. You want to ensure that your property is maintained properly and that you're maximizing your rental income.
And it can also save you a lot of headaches. I've heard horror stories about landlords who didn't have a solid plan in place and ended up with nightmare tenants or properties that fell into disrepair.
Yeah, it's crucial to have a strategy for screening tenants and managing the property effectively. And, you know, for those over 40, it's important to think about how much time and energy you want to invest in managing properties.
Right, some might prefer to take a hands-off approach, especially as they get closer to retirement. So outsourcing property management can be a smart move, allowing you to focus on other aspects of your life or investments.
Exactly. It's about creating that balance. And then there's the aspect of wealth transfer to family. If you've built up a portfolio, having a plan in place for passing that on can make a big difference in how your loved ones handle it.
It's such a vital conversation to have, especially as families start to think about generational wealth. I once spoke to a family who was in the process of transitioning their rental properties to their children. They really focused on educating their kids about real estate so they could manage it effectively.
That's a smart strategy. Teaching the next generation about property management and investment can empower them to make informed decisions. It's not just about handing over keys and expecting them to figure it out, right?
Exactly. It's about building that knowledge base. And with the current economic trends, having that kind of understanding can be a game changer.
Absolutely, Sarah. And as we look at the current state of the economy, there are opportunities out there. While some people are feeling uncertain, others see potential. It's all about perspective and being willing to adapt.
So true. And I think this is a pivotal moment for many. They need to think long-term about their investments, especially given how quickly things can change in the market.
Yes, and that's why we're going to dive into some core strategies soon. It's essential for listeners to have actionable steps they can implement to navigate this transition smoothly and effectively.
I can't wait to hear those strategies, Mike. I think they'll really resonate with our audience, especially those who are looking to build that long-term wealth and security in their lives.
So, once you've flipped a property and you're ready for that transition to property management, it's really important to have a solid strategy in place. One of the first things I always recommend is to evaluate your numbers using some of those classic rules of thumb.
Right, like the 1% rule?
Exactly. The 1% rule suggests that a rental property's monthly rent should be at least 1% of the purchase price. So if you bought a property for, say, $200,000, you'd want to aim for a rent of around $2,000 a month.
That's a good baseline. It helps you quickly gauge if a property is worth pursuing for rental, right?
Definitely. And then there's the 50% rule, which is another quick way to estimate your operating expenses. It suggests that about 50% of your rental income will go towards expenses. So if you're bringing in $2,000 a month, you'd budget about $1,000 for things like maintenance, property taxes, and management fees.
That makes sense. It's all about keeping those expenses in check.
Exactly. And then there's cap rate, which is a bit more detailed but super important. The capitalization rate gives you an idea of your potential return on investment. You calculate it by dividing the net operating income by the property's purchase price.
Can you break that down a bit more?
For sure. So let's say your property generates a net operating income of $24,000 a year, and you bought it for $300,000. You take that $24,000, divide it by $300,000, and you get an 8% cap rate. That's pretty solid.
Right, so an 8% cap rate means you're earning 8% on your investment annually before financing costs, right?
Exactly, and the higher the cap rate generally, the better the investment, but you have to balance that with risk. Higher cap rates can sometimes indicate more risk in the property or the area, so always look at the bigger picture.
Got it. And what about deal evaluation checklist? Do you have a go-to list for that?
Oh, absolutely. I like to break it down into several key categories: location, property condition, financials, and potential for appreciation.
So for location, what do you look for?
Well, consider things like proximity to schools, employment opportunities, and amenities. You want to make sure it's in a desirable area.
Right, and property condition?
Look for any major repairs needed, like the roof, plumbing, or electrical systems. Those can eat up your budget quickly if you're not careful.
And then financials?
You'll want to analyze your cash flow, your financing options, and how the numbers stack up against those rules we talked about earlier. If the numbers don't make sense, it's a red flag.
Makes sense. And how about potential for appreciation?
Look at market trends, historical data, and even talk to local real estate agents. If the area is growing, that's a good sign.
So it sounds like you're really looking for properties that not only cover their costs, but also have room to grow in value over time.
Exactly. And keep in mind, the financing options play a huge role in all of this.
Like what?
Well, you've got traditional mortgages, of course, but also consider things like hard money loans for quicker flips, or even partnerships if you're looking to share the investment load.
Partnerships can be a game changer, can't they?
They really can. They allow you to pool resources and share the risk, which is especially helpful if you're new to this.
And what about different property types? Do they affect your strategy?
Absolutely. Single-family homes tend to be easier to manage and often attract longer-term tenants. Multifamily units can provide more cash flow but require more management.
And with that comes the need for more thorough management, right?
Exactly. Each property type has its own challenges and benefits, so understanding what you're getting into is crucial.
So let's say you've evaluated a deal and everything checks out. How do you ensure a smooth transition into property management?
Well, first, it's important to have a solid management plan in place before you even close on the property. Decide if you're going to manage it yourself or hire a property management company.
And if you're doing it yourself, what should you focus on?
Communication is key. Set clear expectations with your tenants and establish a system for addressing maintenance requests.
And if you hire a management company?
Make sure to vet them thoroughly. Look for reviews, ask for references, and understand their fee structure.
So choosing the right management option can save you a lot of headaches down the road.
Absolutely. And once you have everything set up, you can focus on growing your portfolio instead of constantly putting out fires.
That sounds like a dream. But I imagine there are some common pitfalls to avoid, right?
Oh, definitely.
Let's dive into that next then.
So, one of the big mistakes I see investors making, especially after a flip, is over-leveraging their properties.
Yeah, that's a tough one. It sounds tempting to take on more debt to maximize your investment, but it can really backfire, right?
Exactly. I've had clients who thought they could handle multiple properties at once, but when the market shifted, they found themselves struggling to cover the mortgage payments.
Right, and it can happen so quickly. You think you're on solid ground, and then bam, market conditions change.
Yep. I remember a client who had just renovated a couple of properties and was looking to buy a third, thinking they could easily manage it all. But then they ended up with unexpected repairs on the first two.
Oof, that's a tough spot to be in. Did they end up having to sell one of them?
They did. And it was a hard lesson for them, They learned to really evaluate their cash flow before making a big leap. They had to rethink their entire strategy.
That makes sense. Cash flow is so critical. I think a lot of first-time investors underestimate how important it is to have that steady income coming in.
Exactly. And then there's the issue of bad tenants.
For sure. It's like the nightmare scenario for any landlord.
Right? I had a client who didn't screen their tenants properly. They were eager to fill a vacancy fast and ended up with someone who consistently missed rent payments.
That's so frustrating. Did they end up having to evict them?
Unfortunately, yes. It took months to get through the legal process. All that time, they were losing money, and it really cut into their cash flow.
That's such a valuable lesson. How important it is to thoroughly vet potential tenants.
Definitely. A good screening process can save you a lot of headaches down the line. And speaking of headaches, ignoring the hidden costs can really derail your plans.
Oh, totally. I think a lot of investors think they know what their expenses will be, but there are always those unexpected costs that pop up.
Exactly. I had a client who renovated a property thinking they'd budgeted everything right, but they didn't account for property management fees, maintenance costs, or even things like insurance increases.
Yeah, those can add up quickly. Did it affect their profit margins?
It did. They ended up making much less than they anticipated on that flip. It was a real eye-opener for them.
That's so important to highlight. Budgeting realistically. But what about timing the market? That's another pitfall, right?
Absolutely. Some investors think they can time the market perfectly and only invest when prices are low. But that can lead to missed opportunities.
Right, like waiting too long and then watching prices shoot up.
Exactly. I know someone who hesitated to buy a property because they thought prices would drop further. But they ended up waiting too long, and the property they wanted saw a significant increase in value.
That's so frustrating.
It really is. The key is to focus on the long-term potential rather than trying to time the market.
And if you're investing for cash flow rather than just price appreciation, that can help too.
For sure. If you're looking at the numbers and the cash flow works, it's usually a good investment, regardless of market fluctuations.
That's solid advice. But, even with all the right strategies, sometimes things just don't go as planned.
Absolutely. And that's why it's important to have a contingency plan in place.
Right. What's a good way to prepare for potential setbacks?
Well, keeping a reserve fund is crucial. That way, if something unexpected comes up, like a major repair, you're not scrambling to cover the costs.
Yeah, it's like having a safety net.
Exactly. And also being aware of the property's condition before you buy, that can really save you from surprises.
So, like, doing thorough inspections and maybe even getting a second opinion if something seems off?
Exactly. A good inspector can catch issues that you might overlook. And if something feels off, trust your gut.
That's great advice. So, how can listeners spot these red flags early on?
Well, first, always do your due diligence. Check the property's history, talk to neighbors, and look into the market dynamics of the area.
And maybe consider getting a mentor or joining a local real estate group?
Absolutely. Networking can provide insights that you might not find on your own. You can learn from others' experiences and avoid some of those common pitfalls.
That's so true. It's all about learning from one another, right?
Exactly. And if you do find yourself in a tough spot, don't hesitate to reach out for help.
Yeah, whether it's from a financial advisor or a real estate professional, there's no shame in asking for guidance.
Right. And remember, every mistake is an opportunity to learn and improve your strategy moving forward.
Such a positive mindset. So to wrap this up, what's the takeaway for our listeners on transitioning post-flip?
Focus on cash flow, conduct thorough tenant screenings, keep an eye on hidden costs, and always be prepared for the unexpected.
And don't get too caught up in trying to time the market. Just make informed decisions based on your long-term goals.
Exactly. And remember, investing is a journey, not a sprint.
Well said. It's all about building that wealth over time.
It sure is.
So what's next for our listeners?
The next steps would be to evaluate your current strategy, identify any potential weaknesses, and consider making adjustments based on what we've discussed today.
Sounds like a plan. It's all about continuous improvement, right?
Absolutely.
All right, let's keep the momentum going.
All right, so let's dive into some practical steps that listeners can take right now to make that transition from flipping a property to managing it.
Yeah, definitely. I think the first thing folks should do is really evaluate their current situation. Look at where they are in their investment journey.
Exactly. So one immediate step could be to create a checklist to assess what you already have. Like, are there any repairs needed? What's the rental market like in your area?
That's a good point. It's all about understanding your property and the market. And speaking of the market, tools like Zillow can be super helpful for researching property values and rental rates.
Right. And don't forget about the Bigger Pockets calculator. It's a fantastic way to analyze potential cash flow and expenses. It helps you see if a property can really work for you long term.
For sure. And if you're looking at rental comps, Rentometer is a great tool to quickly gauge what similar properties are renting for in your area.
Yeah, and if you have access to your local MLS, that can be a goldmine for detailed property data. It really helps you stay ahead of the curve.
Absolutely. And while we're talking about tools, I'd recommend checking out DealCheck too. It's really user-friendly for analyzing deals and tracking your investments over time.
Good call. But sometimes it's not just about the tools. It's about building the right habits. Perhaps start by analyzing one deal per week.
That's a manageable goal. Just set aside some time each week. You can even join a local real estate meetup to share insights and learn from others in your community.
Networking is key, isn't it? Connecting with others can provide fresh perspectives and keep you motivated.
Exactly. And don't overlook the power of education. There are some fantastic books and podcasts out there. You might want to check out the book on managing rental properties by Brandon Turner.
Oh, that's a classic. And for podcasts, I'd suggest Bigger Pockets Podcast. They have tons of episodes focused on property management and investing strategies.
Great suggestions. Also, starting small with your management tasks can be less overwhelming, like creating a simple spreadsheet to track your income and expenses.
Right. Just start where you are and gradually build on that. Maybe even set a weekly goal to review your financials or check in on your tenants.
Consistency is so important, and it helps you stay engaged with your properties. Plus, it builds your confidence over time.
Definitely. And while you're building those habits, consider setting up a property management system. Something like Appfolio or Buildium can streamline your processes.
Those platforms can really simplify things, can't they? Plus, they often have great customer support if you run into any issues.
Exactly. And remember to keep an open line of communication with your tenants. Being responsive can help you maintain good relationships and reduce turnover.
So true. A little attention can go a long way in keeping tenants happy and invested in the property.
And if you're thinking about hiring a property manager later on, start researching local companies now. Read reviews and maybe even ask for recommendations.
That's smart, because when the time comes, you'll feel more prepared to make that decision. Having options lined up can ease the transition.
Absolutely. And let's not forget about setting up a maintenance plan. Investing in preventative maintenance can save you a lot of headaches down the road.
Right. Whether it's scheduling regular inspections or establishing relationships with reliable contractors, it's all about being proactive.
Well, I think we've covered a lot of ground here. These actionable steps should really help our listeners hit the ground running.
With these tools in your pocket, you're ready to move forward. There's still more coming up, so stay tuned.
So, as we wrap up this episode, let's quickly recap some key takeaways from our discussion on post-flip property management transition.
Yeah, absolutely. First off, we talked about the importance of having a solid plan in place, right? Transitioning from flipping to managing a property can be a bit tricky, so preparing ahead really helps.
Exactly. And then there's the significance of tenant screening. Finding the right tenants can make or break your investment, so taking the time to vet them thoroughly is crucial.
Right, and we can't forget about setting clear expectations with your tenants. Clear communication can prevent misunderstandings and foster a better landlord-tenant relationship.
For sure. And lastly, we discussed the value of staying organized. Whether it's keeping track of maintenance requests or financial records, being organized can save you a lot of headaches down the line.
Yeah, it all comes down to being proactive rather than reactive, doesn't it?
Definitely. Building wealth through real estate is a journey, and it takes time and effort. But when you approach it with the right mindset and strategies, it can be incredibly rewarding.
Absolutely. And remember, wealth doesn't happen overnight. It's about those small, consistent steps that build up over time.
So, if you found something valuable in today's episode, we'd love it if you could like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
And don't forget to share this with someone over 40 who's looking to invest in property. We all know someone who could benefit from this information.
Next time, we'll dive into short-term rental arbitrage, lease and sublet. It's going to be an exciting topic, especially with the rise of platforms like Airbnb.
Yeah, you won't want to miss that.
Thanks for joining us today.
Until next time, take care and happy investing.